I think we're live. This is Value After Hours. I am Tobias Carlisle, joined as always by my co-host Jake Taylor. Our special guest today is Eric Cinnamond. We've had him on before. He's a small cap value specialist, and his firm is Palm Valley Capital Management. How are you, Eric? Welcome.
Hey, Toby, great to see you. Jake,
Welcome
always
back.
good to speak with you.
Yeah.
How is small cap value doing?
Awesome, incredible.
Yeah.
Um,
Objection, leading the witness.
I mean, there's no better place to be than active small cap value.
Mm.
And then you sprinkle on the absolute return tilt, and yeah, things couldn't be better.
Well,
It's
there's two
just,
things. What's the opportunity set like, and what's I know what the performance is like, but how's the
Let's
opportunity
not worry
set?
about the historical. How's it look going forward?
The past is the past.
Yeah.
Well, what's interesting though about the past is the last 4 years, people don't realize this, but small caps have gone nowhere. I mean, 4 years is a long time. I mean, that's college, right? Um, have made no money, maybe up one, it's like 0 to 1%, depending on the benchmark. Meantime, the S&P 500 is up since that time, 50%. The QQQs are up around 50 or 60. So significant underperformance in small caps. We've been able to hang in there and generate a, small annualized return, I think since inception, we're up like 7, which is around the same as the small cap benchmarks. But as you know, we really haven't been invested too aggressively. We've been very defensive, especially with the cash. On average, we've only been about 20-25% invested since inception. So, macro perspective, I guess, or from the top down on performance, it hasn't been great, but we've kept up, but definitely have lagged the larger cap, which, I mean, I don't know how you can keep up these days. I mean, the Nvidia, I heard is like 8% of the S&P 500 right now. If you have a 5% weight in that stock, you're actually conservative.
Yeah.
You
Right.
might have a little too much tracking error to keep your job with a 5% weight. So things are a little nutty again. It's not too dissimilar than 1999. I used to think it wasn't like 99. Small caps were much more inexpensive in 99. But lately, I think year to date, especially with the flows going more towards large cap or all towards large cap, flows in small cap ETFs are actually negative now year to date. So we're getting outflows, and you're getting this kind of this consistent drip of small caps. Occasionally, you have a really good day like today, where they try to flip the narrative, but without the flows, it's going to be really hard for small caps to rebound.
Why do you think small caps have struggled so much over the last 4 years?
Well, a lot of it's the flows, and a lot of it's the cycle. And the mega caps, of course, have been where the earnings growth have been. The earnings growth for a lot of small caps have been flat. From since 21, we had the boom in profits and stock prices. 22, stocks rolled over, and since then, it's been hard to grow earnings for a lot of these companies. You have a lot of goods companies that boomed during the COVID period because of all the stimulus money, the checks being handed out. And now several, all the consumer names are now in recession. Transportation's in recession, energy's rolling over. There's a lot of industries now that are in recession. That's one of our themes is to buy businesses already in recession. We're not waiting. We really love to buy cyclicals that are experiencing declining earnings, declining revenues, and are in recession. So, but to answer your question, I think a lot of it's flows, earnings growth, and buybacks too. I think buybacks is a significantly underrated, understated catalyst of asset inflation, especially, I mean, obviously in the equity markets, where that's been more towards the large caps, where you have profit growth, you usually have the ability to or more likely to do buybacks. Buybacks now are 4 to 5 times greater than passive flows. Everyone talks about the passive flows, but the buybacks are much larger on a flow perspective. So I think that's helped the large caps as well.
You think the large caps are, yes, the large caps are doing lots of buybacks, but at very elevated valuations, and they've got the cash
Well,
flow to support
isn't
it.
like Apple's get like planned to be like 100 billion of the 1 trillion that are, kind of scheduled or something. Like it's a insane number.
Yeah, the buyback for Apple, I think, is 100 billion. Their market cap now, I think it's trying to get you be the next one to 4 trillion. I think it's three something. So on a percentage basis, the buyback, you're like, well, it's not all that, relative to the float, but it's a lot of their, if not all of their cash flow. So Apple's balance sheet is, and I'm not an expert on Apple, but just by glancing at it, it's really not that strong. It has, last time I looked, I thought it had negative working capital. I know they have some securities on the balance sheet, but that's offset by the debt now. It's not the balance sheet everyone used to talk. Remember, everyone used to talk about Apple's balance sheet. It's a lot worse than a lot of the companies we follow. Small caps. I mean, when you do it on a percentage basis. So I don't really get the Apple balance sheet. And of course, now they've committed to investing. What was it, $600 billion of capital in AI and our chips, or investing in the U.S. And I don't know where that's going to come from, if they're going to borrow to do that. So yeah, Apple's really interesting, but again, I'm not an expert.
You can just say those sort of numbers, though, can't you? You just say, I'm going to invest 500 billion, and they're just like, no one knows
Okay.
what that means.
Yeah.
Yeah, and we were talking earlier about AI, and if it maybe the number is 500 billion a year in investment. I mean, and that is just a crazy number. It's just we just throw around these big numbers now because they've gotten so big. But I mean, I remember back in the tech bubble, we weren't anywhere close to that kind of investment in the internet and in telecom. So this is a lot of money. We go through the conference calls like we do last quarter. I don't think any company we really follow said anything positive about AI or using it, to enhance productivity yet or and create revenues. Of course, it's very early. But that's a big capex number. You have to hope at some point you get a return on that capital, but it's a huge uncertainty. But it is one of the areas that is driving investment in capex. That's one thing I would say, where we have a lot of industries now in small caps in recession. The ones that are doing well, a lot of them are doing well because of kind of that forced investment or the aggressive investment, either in infrastructure because of government spending or AI infrastructure.
It feels like .com 1.0 in the sense that there's an enormous amount of excitement and investment in AI, but no very clear path to generating much income or revenue out of it. And I wonder if, I understand that the AIs are getting close to their limits of like how much we can improve them. And so the next part of the story is going to be making it useful and building it out, which is sort of like what happened to the .com post 2000 to 2025 was building out all the
Yeah, I
internet
mean,
tools.
AI right now, what you could do with it, it's obviously a very good search engine, but it also writes very good raps. I mean, if you're like rap music, so if you're a rap content provider, I think you're toast. You might as well find a new gig. Another thing it does, and not too well, was I asked AI what particular bat to buy for my son. He's in 14U baseball, and it told me to buy a drop
I can help.
five for.
I can help you with that one.
Yeah. Well, Jake had said a drop five, but the rules for this league, and I gave him
Oh,
specific league and
14
age,
you need BB core.
you need BB core, drop three. So I go out and buy the drop five. Well, AI cost me $300. So there you go. So far, AI is not helping me.
It does make a lot of mistakes. I think we've
Well, it's interesting with AI. You'll use it and you're like, wow, it knows a lot. It's very interesting. But then you ask it about something you know a lot about, and you're like, wait a minute, this is not right.
the other thing it does, like it's trying to find the most likely word that follows the word that came before, and so it gives you the most
Yes.
mid take on everything. It gives you the absolute mainstream take. Like if you want to say
Yes.
something interesting, which is like definitionally not the
That's
mainstream
right.
take, it's going to be a fringe take. It's
Yes.
terrible, I think, at generating those fringe ideas.
I agree. And the content is just like you said, it's mainstream. It's not very creative. I actually recently tried to ask it to write a blog for me using our content on our website. I was just curious. And it just it was almost like a highlight reel of what we had written. It just wasn't very good.
Mm.
But I mean, you do spend 500 billion. I hope it improves, and I'm sure it will. So it'll be interesting to see how that plays out. But just like the tech bubble 99, a lot of those companies, same path of the stock price, eventually collapsed. Many went out of business. The ones that were initially benefiting. So we'll see where this all goes. I'm sure something will come out of it, but how it affects asset prices and the economy too. Because right now you've got AI boom, you have government spending boom. 2 trillion deficit, 6 trillion in spending. You got credit spreads are tight. Asset prices, stocks are at record highs. Home prices are at record highs. They never came down. I think it's really tough in this environment to be in a recession. So we've been very critical of valuations, but we haven't really said, we're in a recession because there's just so much spending, so much stimulus to drive earnings and drive the economy. And even though they're artificial, they are having an impact. So, we're careful to extrapolate this environment. So I think we're normalizing instead of extrapolating, which is keeping us out of a lot of these names if you use sort of more normalized profit margins.
That's one thing I did notice when I went through the Denny site. They track the profit margins for large, mid, and small, and I published this on Twitter. And the large is at like, I forget now, but it's like 13 plus, could be 15, something crazy like that, against the long run average of 6. And
Yeah.
then mid is well down, but it's still higher than it was pre-COVID. And so small, which I found really shocking. The margins there are still higher than they were pre-COVID, even though they're well below mid, which is well below large, but they're still elevated. So I don't know what all that means. I don't
I
know
wouldn't
if
have
we're
thought
just
that. I would have thought Russell 2000 margins look like crap with just based on the narrative.
Yeah, we're finding a lot of have and have nots. There's some businesses that are generating incredible margins. Those are the ones that have benefited from asset inflation and inflation in general, where they've been able to pass on pricing. You look at something like a Costco. If you have 30% inflation over 5 years and you can pass all that on, which they have, their margins have been maintained. I mean, they love that. They love inflation. Uh, you know, Maintaining your gross profits and gross margins are two different things. They maintain their gross margins. So inflation can be wonderful for certain businesses, but it can be detrimental to others that are more price takers and don't have that ability to pass on prices. So I think you're seeing a lot of dispersion um, from a bottom up on margins, and there's certainly things that are skewing that number one way or the other.
Eric, wouldn't you say though that that's kind of like a short-term phenomena where your fixed costs were paid for with, higher, more
Yes,
appreciative dollars, but then when it comes
absolutely.
time to start putting a new roof on a Costco or
Amen.
build the
Yep.
next one, it's going to be more expensive to do that, and eventually that's going to show up in your margin, right?
That's a great point. I don't think that gets discussed enough, but frankly, when do fundamentals like this get discussed? I mean,
Yeah.
this is,
There's one
saying
one
that your
podcast
capex
left.
is below average because of inflation. I mean, that's a great point. So right. So margins using, historical depreciation are likely overstated. A great example are a new truck now for the trucking companies, probably 20-30% higher, especially with the new standards on fuel efficiency. So there's a lot of that. So there's a lot of deferral going on because they know, and trucking is another good example. They are deferring purchases of new trucks. A lot of the public companies are. That's also because of trucking's in recession. But nonetheless, when they eventually have to go back in and rebuild their fleets, it's going to be a lot more expensive. But that's across the board. That's a lot of PP property, plant, and equipment.
Yeah, that's like the next investor's problem 2 years from now.
Right.
Who
next
cares?
CEO, next
Two,
CEO's
three
problem?
years down the road, that's like three generations of investors.
Yeah, that's
What do you think the earnings of smalls? Do you think there was consumption pulled forward through COVID and through all the stimmy that's come afterwards? Because I've noticed the same thing that there's a very definite peak around 22 in terms of margins, in terms of earnings, in terms of stock
Yes.
prices, and then it's run backwards since then
Yeah.
to today.
Yeah, I agree. So like an example would be Carter's, right? They're the market leader in children apparel, baby apparel. Um, they were crushing it after COVID. Everyone was getting their stimulus checks, and they didn't really care if they were paying $10 or $12 for a pair of pajamas. Um, so they were able to raise prices, and not only did they have some volume growth, they had the pricing power, and all of a sudden they were making considerably more margin and cash flow and profits. They start buying back stock in the 80s, $100 stock. It's just booming. They're making $8 a share in earnings. Um, and then the COVID stimulus went away. The inflation hit. Now young families are having to decide between, paying rent and buying new pajamas.
Yeah.
And the decision's a lot more
Student loans they got
difficult.
to pay now where they weren't before.
Yeah. So now you're like, all right, I'm going to pay rent, and now no pajamas for Timmy. And so now their earnings are probably $2, $3 a share. The stock's at 25. Um, and a lot of companies did that, especially on the consumer side. They extrapolated that boom. Transportation did it too. And now some have gone bankrupt. Most are in recession. And it's an area of the economy that I think illustrates what's going on with the consumer. The difficulty they're having making ends meet, and especially on discretionary spending, but even food. I mean, even staples now are getting hit by I call it the affordability crisis. Everyone's focused on inflation, but the companies will tell you it's not inflation. It's the inflation we already had. It's the 30%, lower purchasing power or cut in purchasing power. And it's affordability that's the issue. And they're not addressing affordability. I mean, the inflation rate's at 3.1% now on the core they reported today. And we're actually talking about cutting interest rates when the biggest problem, if you do a survey, it's the cost of living. And they're going to cut interest rates in this environment. Stock prices are at all-time high. Home prices are at all-time high. Cryptos are 4 trillion market cap. I could go on and on. Credit spreads are so tight. Corporate bond market's on fire. And we're cutting rates in this environment. I mean, it is insane, and I don't get it. And it's like, what are you doing? The populace is going to vote everyone out. They're going to give, won't say that. All right, I'm going to back up here. But they're going to vote them out, right? And they're going to bring someone in that's going to redistribute the wealth. And you can't blame them. I said no rants, Toby. I'm sorry.
No. Welcome to rants.
Other than that, how was the play, Mrs. Lincoln?
I love the Fed. The reason we love the Fed is they always screw up. You don't know when, but when they do, it's so bad, and the opportunities are so wonderful. And this is going to be one of the best cycles ever for patient investors and disciplined value investors, which we talked about earlier. There's probably about 14 left. It's going to be great. So I like to rail on the Fed, but at the same time, you got to appreciate what they do and the volatility they eventually create in the aftermath that will help us and our clients hopefully make some money.
I think Powell's done a reasonable job. I think that the problem was the three lunatics who preceded him who have created I think Bernanke certainly was probably the worst of the lot, but then Yellen's just continued everything that Bernanke did. And Powell's been the first one to raise rates, even though he's probably done it too slowly. But if I understand that people use the 2-year as a reasonable proxy for where the Fed funds rate should sit. And Powell, I think, has tracked it more closely than anybody else, even though he's a little bit below through the entirety of the 2020 recovery. What do you think?
Well, I think, in 2018, I thought the same thing. And he started to raise rates, and it looked like he was going to try to normalize the balance sheet. And then stocks fell 20%, and he flipped so fast.
Yeah.
Stopped raising rates, started to QE again. They called it something else. And then during COVID, every company we were following practically was clearly forecasting higher prices. Their costs were going up. We wrote about it a year before. And it just was so obvious. And we couldn't believe the Fed wasn't still at zero, and they were still printing money. I mean, it was crazy.
What are all these
and then
PhD
a year later,
doing there?
yeah, it was 9% inflation. And then, everyone says, what's going to bring down this market cycle? I said, well, I thought 9% would have done it, with inflation, but it didn't. So I think he started out with good intentions, and I think all the central bankers probably have good intentions, but no one wants, and it's not his fault that he's in this situation. I agree. I think Bernanke was the godfather. I mean, Greenspan was, he was horrible too, but at least he never printed money, right? Bernanke printed money thinking that was actually a solution to our problems, which every central banker that studied history should know that this is the last thing
he
you
studied
want to
history.
touch.
He was an expert on the Great Depression.
Yeah. Well, people talk about housing now, and I'm like, because we sold our house in the bubble, and I would sell it again if there wasn't money printing, but it's such a big risk to sell and rent right now because of the fear or the real possibility of them resorting to QE, which they're probably going to have to do at some point. So anyways, I was a fan of Powell also first. I think he tried to do the right thing. And then when he saw, like, whoa, I can see how this could all unravel pretty quickly with me, trying to do the right thing. He backed off, and now he's just trying to make it to the finish line. And I think he's going to make it. But just like Greenspan made it to the finish line and still got blamed for the housing bubble. I think Powell, who printed more money than any U.S. central banker in history, will also get the blame when the cycle
on an
ends.
absolute base,
partial.
Off a higher base.
Yes, but I agree with you on Bernanke, and Yellen just she didn't want to do a whole lot of anything. She's just like, whoa, I'm just gonna not do anything and see if I can get through this, and she did. Credit to her. So yeah, it's been a fascinating central bank kick the can. It's just like an average banker. When you have bad loans, how do you not let bad loans go bad? You write more bad loans. So it creates a perception that as a percentage the loans aren't so bad. So they're just going to keep it going until something snaps.
Do you know the thing that amazes me is we've still got a 10-3 inversion. It's started in 22. We got very inverted. We've been inverted for a very long time, and then it's been basically at zero or slightly inverted for the last like 18 months or something like that. So we're now like 3 or 4 years into this inversion.
Is that a record?
It's a record in the data that that they have on the Fed website. But I've heard from I'm forgetting the firm name, but Adam Butler and Co. said that
Gestalt.
Gestalt has a longer history that shows that there have been very long inversions in the past, in the last like since 1900 basically.
Yeah, the long end's interesting. I think the 10-year now is a little over 4, and the 20-year, is like 4.85. So you could still get a decent absolute return yield if you'll take the maturity risk. It seems 5% for the Fed is a scary number. Every time we get close to exceeding that on the long end, it's like someone seems to be on top of that, making sure we don't break out there. So that would be a hard number or interest rate for us to afford. And I think the government's very aware of that.
It's been up every single year since 2020. I've plotted out the curve since 2020, and it's been up. The long end has been up consistently every year by a point or so, including like 24 to 25. The front end has moved all over the place, but the long end hasn't looked back at any point. I don't know what they do about that, if they need to do anything.
Yeah,
I don't know.
What was the 10-year when the Fed cut last year? It was 3 something. I think it's up. I'm not positive. 50, 75 beeps. I don't follow the 10-year too closely, but I know it's up quite a bit. So I think that may have caught them off guard, where like, whoa, we lost control of the long end here.
Well, certainly mortgage rates haven't followed the Pied Piper's tune.
And what happens if mortgage rates do fall? What if they do cut rates, let's say to 0, and mortgage rates go back to 3 to 4%? You should see $1 million home around here. It's like, so what? And now you're going to drop rates, and spur the housing market again. That goes back to affordability, and I don't think you're doing anyone any favors, except people with paper assets.
But I don't think it helps much either, because there's a lot of selling pressure that's going to come through from the boomers downsizing or, shuffling off this mortal coil over the next 20 years. There has to be buyers on the other side. No, it's not going to be BlackRock. There has to be some young family somewhere.
Right. It should
Thank God for BlackRock keeping those young families out.
Yeah. Well, going back to Carter's, one of the headwinds they've had is the birth rate. The younger generations can't afford to have kids. It's kind of sad when you think about it. If you want to talk about the consequences of easy money, I think one of them is clearly there's less babies. So that's not cool. So, yeah, that's going to hurt a lot of things going forward. Population growth is going to decline. Well, plenty of money, plenty of paper money, but fewer people to make goods and services.
Well,
AI
surely,
and
surely if
robotics.
you can print wealth, you can print babies. I mean, this is
You would think. Well, AI might fix that somehow. We'll see. They might not be humans, but
true.
What's interesting in small cap land in terms of industries? What do you think about energy?
we bought our first energy stock last quarter. Cord Energy. It's an E&P out in the Bakken, and so we valued it about $139. We're trying to value the cost of the reserves in the ground, which we believe is about $15 a barrel. Has over a 5% dividend. That one of the things I like about energy is how they've been so disciplined with cash flow. And I thought at first, because most of the time I've been in the industry, since the early '90s, they all just drill, regardless, they got paid on production growth. But over the past 10 years, they've done a really good job. But when oil prices got down, in the 50s, a lot of the E&Ps started to sell near replacement cost of the reserves. So that got it very interesting. We were able to pick one up there. So we like energy. Not all of them, but we like certain ones, especially the ones with better balance sheets. Some of them, because they have been paying out dividends and buying back stock, don't have the best balance sheets. So we're really careful there. We like transportation. We like the trucking companies. We own Heartland Express. That's old school value stock that's gotten absolutely destroyed. So we like companies that are already in recession, and that's a great example with the trucking companies. This is the third year that they've been in recession, the business and the industry. And we're avoiding companies that are doing really well, so we're sort of the opposite.
Me too. That's
Yeah,
how I do it
Right.
too.
yeah.
Well, and their stocks too. So it's been a lot. We talked about this earlier. It's been a lot like '99, where we're buying really out of favor names that the stocks are in decline, the flows are horrible, their earnings are declining. But that's actually when you want to buy cyclicals, when things are bad and getting worse, because the stocks, when you get them cheap, you're not going to get an energy company cheap when oil's at $100 a barrel. You get it cheap when it's at 50. So painful operating results right now for a lot of these companies, but some are stabilizing. We also like companies right now that are intentionally shrinking. Heartland qualifies for that too. They're actually shrinking their fleet. They're spending very little in CapEx. Their depreciation is 160 million a year, and their net CapEx this year is going to be 40 million. So you're getting 120 million free cash flow by breaking even, right? And this is on a 600 million market cap. So they're generating plenty of cash flow. They actually bought back 1 million shares last quarter. We own Monroe. They do auto repair shops. That's another one that's shrinking. They closed 145 stores. They have over 6% dividend. They've generated a ton of cash even in this period. But the consumer is cutting back on maintenance on cars. So just be careful out there. You see a car, you see an older car, it might not have brakes. So might have bald tires. So beware. But people are deferring those. We can only defer those for so long. And but yeah, business has been poor for them. But again, that's a consumer discretionary. That's not really discretionary. But that's when you want to own those too. But their comps have turned positive recently. So we're hopeful there. So companies in recession that are stabilizing even better. Companies in recession stabilizing, they have good balance sheets even better. So that's kind of what we're focused on right now.
Energy versus the market is as cheap as it's been. Only two times cheaper were 2020 and 2000. I think it's kind of
In this
interesting.
environment, wouldn't you kind of want to own something that's tangible at a discount to replacement costs? I mean, I find that attractive. We own a farmland REIT too, Farmland Partners. So if I can buy acreage of farmland at a discount, or reserves in the ground at a discount, or even some receivables. We own Kelly Services, the temp agency. The receivables are at a discount to market cap. That's great. So we love asset heavy companies right now too that are selling at discount to tangible book.
Let me give a quick shout out, and then JT, you want to do some veggies?
Yes, sir.
Senator Mingo, what's up, Danny? Valparaiso, what's up, Mac? Tallahassee, Dead Cat Gully, Andhra Pradesh. Jupiter, Florida, Cincinnati, Boise, Budgie Smuggler, Les Winan in Budgie Smuggler, Australia. Fairfax, Randall, Gerrards Cross, Mean Streets of Gerrards Cross, Emphasis on mean streets. Brandon, Surbiton, Madeira Island, Portugal, Toronto. And John Battle gave us a $50 tip. Thanks,
What?
brother. Appreciate you sponsoring the veggies.
No, that's
Today's
just
veggie
get a part of
sponsor
it.
is John Battle. That's a brand new thing we're doing just today.
yeah, we just thought of it. Better give him a rebate.
Corvallis, Oregon, last one. And then we'll come back to the question. JT, the floor is yours.
Yeah, you guys did an amazing job teeing things up with the first part of our discussion, as you will see, totally unbeknownst. So imagine you're standing on the deck of a wooden ship in the Arctic and the air is stinging your face. It's so cold. It's the spring of 1674, and you've been sailing for weeks through this shifting ice. Your supplies are running low. You probably have scurvy. The men aboard are restless, and Ernest Shackleton won't be born for another 200 years. Then someone shouts, "Land ho!" And you squint toward the horizon, and there it is, an island fortress rising high above the sea, complete with jagged cliffs and snowy mountain caps. It looks so close you could almost throw a rope to it. And the crew cheers, of course. At last, we found salvation. You steer towards it for hours, and yet as you're getting closer, something strange is happening. The island doesn't grow larger. If anything, it seems to be drifting further away, and eventually you realize the terrible truth. There is no salvation. What is going on here? Is this just a sailor story like mermaids or the Kraken, or a superstition like you should always step onto a boat with your right foot? No, the reality is the sailors did see land, but it was actually a mirage. And in fact, you guys might not know this, but there are two types of mirages, superior and inferior. And you've no doubt seen the desert image, which is, the desert mirage, which is that shimmering pool of water on a hot road. That's the inferior mirage. The superior mirage is different. And here's how the physics of this works. Light doesn't always travel in a straight line. In uniform air, yes, but the atmosphere is rarely uniform. Cold air is denser than warm air, and density changes how much the light will bend, and in a property that's called refraction. And this is why things look closer underwater when you're viewing them from above the surface. So under normal conditions, warm air sits near the surface and cool air above it. Think about the temperature up at the mountaintop compared to down in the valley below. In these normal conditions, the cold layer is above the warm, and the light then bends only slightly, and the world appears where it really is. A temperature inversion, which is not to be confused with Toby's rates inversion, flips that layering. The cold, dense air is then near the surface, and then on top of that is the warmer, lighter air. And when that light from a distant object enters this inversion, it curves downward towards the denser air before it reaches your eyes. So your brain, which is assuming that light moves in straight lines, interprets this as the object being higher than it really is. So this temperature inversion is common near the Earth's icy poles, right? Because it's very cold air off of the snow. And the result is these superior images is that objects are hidden by the curve of the Earth. They seem to float above the horizon. You actually can see things like over on the other side of the horizon. So mountains that are hundreds of miles away, appear to be rising into the sky in front of you. And phantom ships may be sailing, beyond where you could see, like there they are. And even coastlines, seem to be hovering in midair. And the images aren't fuzzy. Sometimes they're often sharper than real life because the air acts like a lens and like zooms in a little bit. And this is most dangerous part is that it's incredibly believable that this is actually there. And historians speculate that the Vikings ventured to North America sometime around 1000 AD after spotting a superior mirage of the mountains of Baffin Island from the coast of Greenland. So they're almost like peeking onto the other side of the Earth because of this. And it looked to them like the land was much closer than it actually was. So then okay, let's set off and go explore that. So of course, the cousin in the desert of the mirage is the inferior one, and it works in reverse. And here, heat near the surface bends light upward, which makes the sky actually reflect off of the ground, and that creates the illusion of water on a scorching road or pools shimmering in a false Sahara oasis. So let's see if we can torture this analogy into something useful. In the superior mirage, your eyes aren't really lying. They really are receiving light from something that's real. The problem is your brain's interpretation of it. And that bending of light through layers of air makes the horizon look much closer than it truly is. And the closer you think it is, the more confident you feel steering toward it. So I can't help but think that might be where AI is today. So The cold air is the hard, measurable progress. These frontier LLMs are scoring higher than 90% of humans on specific tests. Automated coding assistants helping, save weeks of development time. These AI agents that are boosting productivity in narrow domains. And those are real tangible wins. Like that's the island on the horizon. The warm air might be the capital markets and the media layer kind of above that. The $1 trillion TAM slides, the breathless coverage about AI replacing entire industries next quarter, stock market pricing and decades of compounding before any cash flows arrive. Half the workforce is being laid off by Christmas. That speculative heat refracts our expectations, bending the arc of reality so that 20-year payoff looks like it's 2 years, away as an inevitable thing. So, these mirages are then precise enough to tempt people into misallocating their resources. So they set sail, they burn precious time and fuel, and when the illusion fades, the true distance finally reveals itself as being greater than ever before. So who knows? Like maybe the real breakthroughs might be a decade away, but the mirage convinces us to act and spend as if the miracle is right around the next bend. And so just like those Arctic sailors, like we might get there eventually, and the land is real, but the timetable probably isn't. So that's why, when I've recently was reading a headline that Meta is tapping PIMCO and Blue Owl for, I think it was $29 billion of debt for data center projects. Like that's a little concerning. Like you tapped your balance sheet, you took a bunch of cash out. Now you're going to, lever it up to keep going. Well, that implies then that there's a time period that you need to reach shore by, and that can be difficult. So I don't know, Eric, are there any signs that you see today that kind of rhyme with the .com period when it comes to this, the future being out there beyond the horizon, but it looks closer than it really is?
Yeah, of course. I mean, it's feeling more and more like 99. I remember 99 still very well. I was a young manager. It just felt the same, where you just felt like an idiot, and you're missing out. It was very hard. We were talking earlier about that's when I went and enrolled for graduate school because I thought, I didn't know what I was doing and my career was over. But of course, and this was what I don't think people really appreciate. The internet bubble popped without warning. I think everyone thinks that there's going to be a bell that rings. They'll have time to reallocate capital, and even though they probably know right now they're chasing a speculative bubble, they think they won't get hurt because they'll be smart enough to get out. But I remember one day just coming into work. It was March of 2000, and it just crashed. I mean, these internet stocks crashed. So I think there's a lot of similarities right now, but investor complacency is probably the biggest. And the feeling again of when you're not participating, I was a lot younger then, so I thought I was a lot smarter then, so it was,
Yeah.
I think it was harder for me than the 99 bubble, because I went from feeling so smart to so stupid. That sort of transition was really hard for me personally, but this time around, I mean, it's still horrible. I mean, I hate not participating. It's, we want to be fully invested. We really do. We want to be making money. We would love to be making 20% a year on the QQQs and compounding that. I mean, just for 1 second, try to imagine being invested in the Mag 7 over the past few years. You go to bed, you're so happy about making how much money you made, and then you start thinking, well, how much are you going to make tomorrow? I don't know. I can't wait. That's going to be so awesome. So
and they're great businesses
feeling,
too.
Yeah.
They're such great businesses. It's so easy to be invested in them.
Yeah. And take that feeling, Toby. And then the inverse of that is what we're experiencing.
And they're terrible businesses. The businesses that we're invested in deserve everything they get.
But here's the bright side, is when it ends, and it will, the feeling of being an idiot, and then transitioning to feeling that vindication feeling. And we don't really care about relative performance, but when you outperform by thousands of basis points, it's pretty cool. So the other side of this is amazing, but making it all in one piece, and maybe with a business, maybe not, and maybe with some clients, maybe not. It can be wonderful. But I think at this point in the cycle, there's just fewer and fewer professional managers willing to do it. And one thing I would note about 99 too, this is very important. A lot of value managers, portfolios did their own transition to try to participate somehow, some way, and they did it by buying growth stocks that maybe they try to classify as value. They try to still hold a value category, but still cheat kind of on the side. Not cheat's probably a wrong word, but give in a little bit on principle to participate. And you can understand that, to try to keep your job and keep assets. So you can still be value, but not really be value. So you have to be really careful right now if you're a capital allocator. Look under the hood. And if you see a value fund doing really well right now, especially in the small cap side,
Yeah.
it might be a red flag. Might not be. It might be an incredible stock selection, but a lot of the genuine small cap values we believe have horrible charts right now. You should see when we're looking for new stocks and we see a horrible 5-year chart, we're like, all right, that looks awesome. That's what we're looking for.
Look at this dog.
Yeah. Oh, give me an ugly 5-year right now. But a really strong performing fund right now will have some really pretty 5-year charts. So I think you want to be careful of those. Do some research, deep digging there, and make sure that there wasn't a shift in philosophy or process and strategy.
Eric, if you were an allocator right now, how would you try to untangle luck versus skill? Especially if you had a 10-year track record to look at, let's say. Which sounds long, but
yeah, but even a 15-year, Jake, now 10 and 15, 5, 10, 15, all tell you to allocate to the S&P 500. And how are models made? How are capital allocations model made? By looking backwards. So everyone's like, oh, small caps are going to come back. They're so much cheaper. I don't know if I would agree with that, because if you look backwards, all the numbers tell you to buy large caps. And that's how these capital allocations are made. The pretty pie charts that you get when you go to an advisor and they tell you how they're going to chop up your portfolio and where it's going to be. The numbers will tell you to be in a large cap. And until that changes, and this is another thing that was similar to the late 90s, 2000, until the large caps get just destroyed and those backward looking numbers don't look so pretty, the small caps are going to lag. But once that happens, in 2000 to 2002, small cap value stocks had very, very good gains. But the large caps, and the NASDAQ was down like 80%, something crazy. So you were able to make money in a severe bear market by doing exactly that, kind of buying what's out of favor before the bubble pops. So you want to be very careful right now, because I think most allocations would suggest to go with what's done well, and it hasn't done just well for a few years. So they can justify it easily by saying it's been 10, 15 years. That's a hard number to dispute versus a 2-year, 3-year, 4-year number. But because the cycle's been so long, you really want to be careful, because we haven't had a real recession or real bear market over that period. You want to be really careful now using this sounds weird, but you want to be careful not to use long periods of time to make investment decisions.
And Eric, when the world is such where, buying every dip has worked, the belief in the superpowers of central bankers and governments to do whatever it takes to, keep corrections from happening. What does it take, like an 80% down, to disabuse people of this kind of Pavlovian dip buying that they've been, so wired to do over the last 15 years?
I think so. And there was an article in the Wall Street Journal, I think it was yesterday, talking about younger investors and how they've been able to buy the dip and have been rewarded. And it really was a "this time is different" article. Another one. We haven't had enough of those. So I do think, as I learned in the 90s, that I wasn't that smart, or wasn't as smart as I thought I was. I think that's part of growing up as an investor, especially for the younger generation. But right now, you can't blame them for thinking they're invincible and, they can make money so easily. I mean, it really, if we wanted to make money, even in our fund right now, I think we could do it. And I think we could make a lot. But I also think we would be setting ourselves up for losing a lot of money, So, and you can't, I'm telling you, you will not be the person that gets out first. I mean, if you do, you'll be very exceptional timer. And we're not market timers, but the risk right now, especially in the large cap side, and I'm not promoting small caps. We don't think small caps are particularly cheap, But they are getting cheaper, and there are more things to work on now, which is great. But as far as the large cap side of the market, I mean, and back in the 90s too, you had Gillette, Coke, 30, 50 times earnings.
Yeah,
Those
really
got
expensive.
destroyed. And people they think because they're in high quality, they're protected. That's not true. Costco at 50 times earnings could easily lose half of its value, easily. So people need to be aware of that as well, that quality is not
Panacea.
a perfect way to control risk. Valuation is much more important.
I got a good stat from Twitter. This was a Bank of America global investment strategy. US large cap annualizing $419 billion for 2025, which was the second highest ever to 2024. US small cap annualizing $80 billion in outflows, which is a record.
Go small cap.
I was amazed that they had that much to lose.
Yeah, what's it?
Right.
That's just all wiped out.
Well, what is the Russell 2000 ETF? It's like 10 billion, maybe. I really don't know.
I, I had a look at IWM, IWN. I
Yeah.
think
Yeah, one of the NRM. There's two of them. There's a
it's four
value and a
it's
regular.
4.4 billion.
Oh, it's embarrassing.
Yeah,
And
I
the
thought that
and
was funny.
the Vanguard or whatever it is, and
VIOO.
what is that? I mean, it's several hundred billion, I think. And the big active funds now, you look at and I don't want to get sued here, so I gotta be careful. The Contra Fund? There's a fund out there called the Contra Fund. I won't,
Who knows who
right?
does it? Yeah.
What does Contra imply to you? Maybe contrarian?
Well,
Maybe?
on Twitter, a contra is someone who you trade against, but yeah,
Okay.
it does sound contrarian. That's right.
Back in the day, it meant contrarian. I don't know what it means now because if you open the hood of that portfolio, it's like the Mag 7 fund. Um, so even the active managers, I think, have figured out, if I don't own the big weights of these names, we're going to risk underperforming and risk losing assets. And the fund's done incredible. And so is the assets under management. So I think if you overweight some of these names doing really well, like we said before, there's a way to make money right now. It's pretty easy. And that's to play along. And if you want to leverage that up, which, we have the leverage ETFs now, we have options. A lot of people are doing that. So it's not just buying the S&P or the QQQs. They're going even further than that. So those flows are huge, Toby. I mean, I remember back in the 90s when we had year 2000, there was like 50 billion inflows, and everyone thought that was nuts.
Yeah.
Now, now we're talking hundreds of billions going into these ETFs and passive funds. So
There are a lot of companies that have stumbled over the last, even in large cap land. I think it's kind of interesting that it is so concentrated into a handful of names that are performing. I don't know if it's 10, but it's certainly in the top 100. And then the 490 or the 400, however you want to break it up, they really haven't done very much. They've been basically also flat since 2022. It's really only a
yeah,
handful of names that have been a beneficiary of that CapEx AI spending
yes,
that
exactly. Yep.
have done well through this period. And a
Oh,
lot of that
yep.
is like, as we were talking about, it's hard they're deploying so much money. Like the returns that they have to get out of that money that they're deploying are becoming like they're equally astronomical on the other side to
Yeah.
justify it otherwise. And I sort of equate it to like a 99 fiber optic cable build out. And that's
Yep.
not an original thought, but it's a common kind of analogy to make. The difference is that the fiber optic cable goes in the ground for 25 years, whereas the
Right.
useful life on these chips, like 3 or 4 years before you get another. Like, are we going to be spending at this sort of rate all the time? Like, is that just what we're doing now?
And yeah, how's that sustainable? I always joke about the tech bubble. At least we've got the internet infrastructure for that. That was cool. And then the housing bubble, though, I go, what do we really get out of that? And then I was like, granite countertops. Everyone got new granite countertops.
Yeah. It does
Yeah.
feel like there's a obsolescence, like, I mean, let's rewind even further back. Like railroads, the huge CapEx boom. I think it was something like 6% of GDP was being spent on CapEx during the railroad boom. Well, some of those rails, obviously they've been replaced, but the right of ways are the same as they were 150 years
Right.
ago, right? Like
That's right.
that's really you
Replacement
amortize
CapEx.
that cost well. But yeah, chips at, let's be generous and say 5 to 7 years even, which I think is what they're they're doing.
Yeah, but the ones
accounting.
they're putting in now will probably be obsolete in 18 months, right? I mean,
Yeah, maybe.
It's great for Nvidia.
Yeah.
I don't know if their
well,
customers can keep up with them.
Well, and in
yeah.
fairness, my understanding is that those chips they then sell on to like the inference side where you don't need quite as much horsepower apparently. So it's not like a total like you
He's
write
gone
this
to
to
China.
0. Well, yeah, I don't know. But so they're not like zeros, but like yeah, the training chips have to be quite the most powerful apparently. So those are the ones you got to replace every 3 years.
Are we
Yeah, this
getting?
is why we do avoid a lot of technology stocks, not because they can't do extremely well, but because they're just hard to value. I mean, we're talking about this right now, and none of us can really quantify what cash flows are going to be in year 5, let alone year 1 or 2, right? So it's just so hard to value, and you're not buying a perpetual bond. You don't really know what you're buying. It's just a tremendous amount of investment with uncertain returns, and that's more speculation. And it could work great, but for us, if you're just kind of discounting a long-term bond sort of investor, those are really hard to plug in a model.
Yeah, you want some steadiness. It seems like energy's not going away anytime soon. I think energy's a reasonable bit. I also saw healthcare is doing underperforming the S&P 500 by the most since 2000, and
We
it
just bought our first healthcare device company, maybe, I mean, in a decade, maybe since our inception, I know. But yeah, you're right; those have been under pressure. So that's interesting you bring that up. We've noticed that as well. One thing I want to talk about, which we haven't, is tariffs. We had the CPI number today come in, and I think the main number was lower than expected, and the core number was a little higher. But a theme I wanted to talk about in the quarter was a lot of the companies we follow haven't reported a lot of impact from tariffs at this point, but it's coming. I mean, it's definitely going to. I just want to be everyone aware of this.
Well, we should set a little context too, Eric, that you do a ton of bottom up reviewing of I think hundreds, right, of earnings calls that then like give you kind of a bottom up economist viewpoint of the economy. Go ahead.
Yes,
Sorry, go ahead.
exactly. Thank you. So we'll get a feel for what's going on with the companies. And I remember in kind of 2021, we were seeing inflation coming. I mean, straight on, and it was very obvious to us. And this is another one of those moments where we see it again. There's going to be a lag, but it's coming. There's 3 things companies are doing. One, they're raising prices. 2, they're trying to pass it on to vendors in the supply chain somehow. And the third thing is they're cutting costs. But almost all the companies we follow intend to mitigate 100% of the tariffs. So they're not going to absorb it. They're going to use prices, and someone else is going to absorb it, and they're going to do productivity cost cutting. So this will have an impact, I think, late this year. Definitely by 2026, inflation numbers will go up, especially on, I mean, they will go up on goods for sure. We believe. So just keep a lookout, even though we haven't really seen it yet, it's in the pipeline. Companies, when this all started happening in April, they kind of all froze. None of them really knew exactly what to expect or the real numbers to use, so they couldn't do anything. But now they have more clarity. They're taking action, and this could affect jobs as well later this year. Early next year, as they're going to cut costs or try to improve productivity. Another thing I like too is a lot of them are going to re-engineer their products. So they used to call it lightweighting, get less, and then the whole shrinkflation theme came out and people made fun of it on the internet. And so now they no longer call it lightweighting; they call it re-engineering, which sounds a lot better. Hey, I'm not getting ripped off. They're re-engineering. That's gonna make it better. But
we re-engineered this bag of chips to have 8 chips in it instead of
exactly. So we followed an apparel company. They're re-engineering shirts to have less cotton, and they spin it. Oh, it's more breathable now.
Yeah.
At some point, we're all going to be naked because of all the re-engineering. But so that's another thing to watch for. You'll see changes in packaging and product offerings and how they were made. So yeah, it's coming. So So there's no free lunch.
The thing that I
Sorry.
don't understand that seems like, if you just think about, like, you ask yourself, and then what, one time on this. Okay, we've got like huge margins, known cost pressures coming from tariffs, just even having to just write the check to the government to get something inside the borders of the country. Okay. And they're all saying they're going to be passing this along, but isn't there one company, two companies that would defect and say, like, well, you know what? I want market share. I'm going to eat my margin that I had. I'm going to pay this, and like, I'm going to pass this savings on to the consumer, which at some point, that's what technology has meant. Like, it's, we all have more from doing with less input. At some point, like, where is the game theory of the competition between businesses to lower or not raise their prices commensurate with the tariff expense?
Well, especially with small caps, a lot of these companies are already under margin pressure with rising costs. We talked about trucking earlier. It's not just demand, but they have a lot of their costs, the labor especially, and the equipment costs, replace equipment that's going up, insurance is going up. So you have a double whammy right now with the costs are rising. So now you throw the tariffs on that too. It's really going to be hard for them to eat it right now, just the way things are going for. And Toby, you talked about this earlier with the S&P 500. The 400 or less, are actually not growing very, very well right now. So it's just a hard time to ask someone a business to eat it. But in aggregate, you're right. I mean, the profit margins you would think would somehow come down, but that's being skewed by the mega caps. But one thing real quick on inflation I want to discuss too is a theme we're seeing too with companies, and that is premiumization, where they are selling more towards those that have benefited from asset inflation. And I think that's really something that, we talk about one times with the tariffs. Something that's not one time until stock prices and home prices fall is this trend towards selling to the wealthy. And they are more lately been more impactful in setting prices than the lower end. So you have two economies: the high end that's willing to pay anything, and the lower end where they're buying less, trading down. There's two things going on. But as the wealthy get wealthier, they've been more willing to pay any price really for, we went to Panera, and I bought my daughter a small mac and cheese and a breakfast sandwich. The breakfast sandwich was tiny; it's like the size of an apple. The mac and cheese was this little bowl, and it was $15. And I was like, "Are you serious? I go, how much is mac and cheese?" She said, $7. I got a Publix and get a whole box for $2.
There goes our Panera sponsorship.
Yeah, but then I was thinking, if I own the QQQs and Mag 7, that $7 mac and cheese. Well,
yeah, that's nothing.
Whatever. Yeah. So they're setting the prices more towards the person that is flush with asset inflation versus the small cap value manager. But so I do think that's really interesting. The price setting right now that's going on. You saw it with Delta, right? Delta's premium seating last quarter was up 5%. Non-premium was down 5%. I think that's the perfect summary of the economy right now, and the perfect summary of what we're seeing with prices. So there'll be some discounting on the low end, maybe, but companies have figured out they're better off doing less and making more. It's a theme they learned during COVID. You don't have to be at full capacity to make money. You can do less, charge people more, make more. It's a lot easier.
Hey, Eric, we're coming up on time. Thanks so much for spending time with us today. But if folks want to follow along with what you're doing or get in contact with you, what's the best way of doing that?
PalmValleyCapital.com is our website. So if you're interested, stop by, and really appreciate you having me. I always enjoy our conversation, Toby and Jay. So until next time, thank you.
Sign up for Eric's blog posts. I read every single one of them.
Thank you, Jake. We appreciate that.
JT, any
we
final words?
We got a great quarterly letter too. Jamie writes that, so I always like to plug that. That's my favorite quarterly letter out there.
Q2, Q3.
Q2. Check it out.
No words of wisdom. I used all my wisdom already for the day.
That's interesting.
We'll see you next week, same bad time.